Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey, everybody. Welcome back to the Working Wealth Podcast. I'm Patrick.
And I'm Haley.
And we are going to take the next few minutes to break down some key financial terms and provide some helpful definitions to hopefully simplify a lot of the common topics or common phrases we use in this business.
Yeah,
right?
Just to help everybody understand so that they know what's going on.
Yeah, because ultimately, we're not like most people. We want to make this relatable and simple, and we're not highbrow on our ivory tower. We think that everybody should have a basic understanding of some key financial terms. So we want to take some time to break that down for you today.
But first,
we'd
like to remind everyone to review, like, and share the Working Wealth Podcast.
Yeah, because otherwise, only our moms and a few people get to enjoy the benefit of these episodes. And we'd love for everybody in the world to get
Friday,
to hear it.
I learned we had another listener.
Really? Who was it?
Yeah, Joy. Our friend Joy.
That's right.
So shout out to Joy.
Yeah. Way to go, Joy.
Thank you for listening.
By the way, if you need bookkeeping and tax help, send us a note. We'll connect you with Joy. We'd love to send her some more business.
Yeah. So it made me very excited.
No, that's great. Awesome.
All right. Well, so I see this list of words.
Yep. Where do you want to start?
Well, where does anyone naturally start? At the top?
In the beginning.
Okay.
There was the word.
Right. And right now that word is asset.
Asset. All right. So asset. What is an asset, Haley? Let's talk about that.
See,
and we've talked about this on the show before.
I know we have, and I'm not going to be able to define it like you will. And I did know that you were going to ask me this question. So I should have prepared a little bit more.
We didn't plan that, though.
No, but see, I've been married to you now. We're going on our
8th year. Yeah.
Okay.
We're technically in the 8th year.
We are in the 8th year.
Yeah.
Okay. So asset.
Yeah.
Is me to you.
Is you okay? All right, so we can use that as an example, right?
Yeah, I just thought that would be clever.
No, that's fun. I love that.
Little anniversary.
Yeah. So an asset is ultimately just something that holds, retains, and can grow in value over time, right?
Exactly right.
Well, thank you so much. Appreciate that. But realistically, like assets in and of themselves are just things that hold value and grow in value over time, or ideally can grow in value over time. If that is the case, like where it does increase in value, we call that an appreciating asset or appreciating asset. But a lot of people probably know this term in the vein of like depreciating assets,
Okay.
We talk about buying a vehicle or buying clothes or other like wearable or usable goods are typically depreciable assets because they go down in useful value over time through wear and tear, degradation, things like that. But ideally, when we think about our financial life, we want to have more assets, right? Because more assets means more wealth, means more opportunity, more sustainability, more security, things like that.
Okay.
So that's what an asset is to me, as well as being you.
Okay,
that's what it is.
Good.
So, but with assets, that is one side of the coin, right? The other side of the coin in terms of our financial life is a liability.
Oh, yes.
So what is a liability, Haley? And you can't say that it's me for you.
Okay.
Although I will pause right there.
Okay.
And you might want to cut this out.
Okay.
But I've had a lot of conversations recently with folks about what are like some key indicators of success in your financial life. And there's a lot of studies that show that one of the most important factors, or two of the most important factors in your financial life for building your wealth and sustaining your wealth is ultimately who you marry or who you spend your life with and the zip code you grew up in. And that's related to just the environment you're in, the culture, the opportunities, things like that. But regardless of that, like I want everybody to understand that we're ultimately responsible for our own financial success, right? We all have opportunity and access to information, resources like this, where we're going through different definitions about financial terms. And we all have that opportunity and responsibility to improve our own situation, right? So Just throwing that in there because we're kind of joking about being assets and liabilities
That's true.
for each other.
We are.
But that is a real thing, right? So making sure, and going back to our episode we talked about before of how to money together.
Yes.
That's really applicable, is making sure we have good communication and relation with our partners in life to be on the same page about money.
So when I
it took
hear
us way off track.
When
Sorry.
I hear liability, I think of a negative thing or a weakness, a vulnerable point. But here is, I guess, where you've opened yourself up to be vulnerable in a financial manner.
Right.
So that's debt.
Yeah.
Right? Is a liability.
Exactly. Yeah.
What are other things that maybe I'm not thinking about that's a liability to your financial future?
I would just go deeper into that, right? Is, if we're talking about specifically financial resources, any form of debt is technically a liability.
Okay,
because a liability is where you have taken on the obligation, where you owe someone something for, like, someone's given you something and you owe them something back in return.
Right.
So like if we think about financial debt, that is, I've borrowed money and I owe the original principal balance I borrowed plus interest back for that debt.
Okay.
That's what a liability is. There's a lot of conversations and debates around like good debts and bad debts and things like that. Ultimately, anything that detracts from your financial success is a bad thing, right? In terms of financial situations. The IRS does actually define what a bad debt is. I was actually reading about that earlier today. And a bad debt is just a debt that you have granted somebody, like you've loaned money to someone, and they have no way to pay it back to you. So that's what a bad debt is, not everything else you see on social media and TikTok and all that. Like, it's just if you have created some kind of debt item for somebody else and they don't have a way to pay you back. Whereas a good debt would be someone can pay it back.
Okay.
In that regard.
Interesting.
Yeah.
So I guess in your financial life, a liability can be. This might be a little brazen to say.
Okay.
Could be an actual debt that you carry, or it also could be lifestyle choices that you're making or decisions that you're making to allow someone or something externally to be a liability and a drain on you financially.
Yeah, I would say externally and internally,
Okay,
right?
Well,
So going back to my comment earlier about the factors that affect your, like, statistically have an impact on your wealth growth. One of those being your zip code, right? Is if you live in an impoverished or depressed area and you want to do better, well, one of the best things you can do is put yourself in environments to expand your mind and expand your horizon, things like that. Same thing with our, maybe it's more of an intangible liability instead of a tangible one, is if I know that I hate my job and I'm not successful at it and my income is capped and I'm not enjoying the kind of work I do, or I don't see an opportunity for advancement, I've got to get out, right?
Yeah.
Like, so the liability there is an internal liability of me not taking action to improve my situation and seek out a better opportunity that could ultimately have a financial impact in the positive or negative
to turn into
based
an
on
asset.
making that decision. Exactly.
Right.
Yeah. And that really goes back to like the concept of action versus inaction, right? If we're always thinking about action and being proactive with our opportunities and success, then we have more opportunity just by nature of being intentional to improve where we are today.
Yeah. Okay.
Yeah.
Well, that makes sense. All right. Number 3.
Yep.
Net worth.
Net worth. Great. We're going to lean on the first two things we defined for net worth.
Great.
So
I think you did that intentionally.
a little bit, right? So net worth is just the calculation of what the value of your financial assets or your financial position is. And it's very simple. It's just take the total amount of your assets minus the total amount of your liabilities gives you a final number.
Boom.
And like we've said
That's
before,
what it is.
we hope it's positive,
Yeah.
but it can be negative.
In a previous episode, I said it can be negative.
That's right. And we want everybody to have a positive and ideally growing net worth over time.
Yeah.
So, but outside of that, let's dive into some different types of assets or some common terms that we throw around, right? So the first one is stocks. So, Haley, what is a stock?
Don't ask me these questions.
Okay.
Stocks, bonds, and cash. I feel like.
Okay.
And I don't really think I'm someone who likes to pose as knowing something when I really don't know.
That's great.
But I feel like though, especially stocks and bonds, I hear people talk about this a lot.
Mm-hmm.
I also hear people come in and talk about this, and I'm like, I feel like they're just buzzwords. And a lot of people throw them around in a way to be like, oh, yeah, I bought this stock. Oh, I'm doing this thing on Robinhood. I'm making this thing. Like, I'm a mover and I'm a shaker. You know,
I love a mover and a shaker.
Yeah.
Especially when there's a rhythm to it.
Yeah. Well, it just makes me laugh because, you know, people really focus on these things. It's an ego play.
Yeah.
Right. And then, you know, then you hear the whole of their financial picture and you're just like, okay.
Yeah.
You know, it just kind of all fits the bill when someone's so keen on just a few things like this.
Yeah.
But a stock, right?
Yeah.
It's a part of a company.
Yeah.
You can own part of a company, and that's how you own a company is through stock options, right?
Yep. Yeah, well,
you can
owning the stock.
You can be given stock options if you're part of like a larger company.
Mm-hmm.
I know they do that at like Cinex. It's not called that. It's like TD Cinex now.
Yeah, a lot of publicly traded companies.
Yeah, exactly. A lot of large companies do that. So that's what stock is.
Yeah.
Owning part of a company.
In short, it is just owning. It's ownership, right? So like in the same way that like with our financial planning business, or if we owned a pressure washing business or we owned a car dealer or whatever, whoever owns the business gets the direct benefit or risk of loss for owning that business, right? Yeah. So if we own stocks, like the joke I make with almost every person I sit down with, like in a first or second conversation is, if you own half of Amazon stock right now, we wouldn't be having this conversation, right? And everybody without fail just immediately laughs because they imagine like being that wealthy, right? But the point there is like the underlying theme is we don't really have to explain it more than that, right? All I have to say is if you owned half Amazon stock, we wouldn't be having this conversation, right?
I feel like
because everybody gets understands
a lot of headlines currently.
It does,
especially with the whole GameStop.
Yeah.
Coup or whatever they say went on there, all these things.
Yeah, right.
So stocks get a lot of airtime.
Right. But I mean, and the key thing there is, you know, it's just ownership, right? You can either own part of a company, or the next one, which is bonds, is you can loan your money to a company. So a bond is literally just a debt relationship where you're the creditor. Like you have actually purchased a bond, meaning you have given your money to a company, municipality, government organization in exchange for some kind of interest payments back over time. And you get your original lended amount or principal value back at the end of the term of that bond. So it's very simple. Like if we think about stocks and bonds, you're either owning or you're loaning. Now, I love to be an owner because we know that if the ones that are loaning money actually thought they wouldn't get money back, they wouldn't loan the money to the people that are borrowing the money, right? So like it behooves us to own stocks and own equities, or another term is equity for stocks, because you have equity or your ownership in the company. It behooves us to own stocks as part of our portfolio because we know we get more growth opportunity by having that.
What attracts someone to a bond over a stock?
Stability, which I would ultimately say is rooted in fear. Honestly. And that's not to say that we shouldn't have them.
But can a bond payoff be that much better than a high yield savings account?
That's a very good loaded question in terms of today's environment. Right?
Okay. Right. I realize that hasn't always been around. Like, the high yield savings account
well, the high yield savings accounts haven't always been around, but we did have in decades past very high interest rate environments where CDs were paying 8, 9, 10%, which is a secured type of bank product, secured type of cash vehicle.
Okay.
But that's getting ahead of ourselves, I think, a little bit.
Sometimes, I kind of do that. I'm like, well, I actually legitimately have questions here.
But to your point, you know, there's a difference between like returns and real returns. So like you can have a return on investment. Like let's say you owned a stock and the return on that stock over time, or you owned a basket of stocks like in your portfolio through mutual funds or ETFs, things of that nature. Other definitions we can define, right? But if you own those things.
We could be doing this exact episode for days.
Oh, yeah, for sure.
Oh, what about this word?
Yeah, right. But if you own that, right, and let's say your return is 9% over whatever specified period of time, we're looking at 9% growth on your money, right? That's great, but you have to adjust that for inflation, right? So if 9% is your rate of return, but inflation is 7%, well, your real rate of return is 2% for that period of time. So that's a great point, and we're actually going to be doing some content about this in the next couple months, is everyone that has a bunch of cash on the sidelines right now. Like, it's been really attractive to keep a lot of money in a high yield savings account, or keep a lot of money in a CD, or keep a lot of money in just the bank where it feels secure and safe. Well, that's great if you're getting 5% return on your money for taking, quote, no risk. But in all reality, there's no such thing as no risk with money, right? Because there's always some kind of risk of, are you missing out on opportunities, like opportunity cost, right? Right. And I was actually listening to a podcast yesterday by one of the great minds in the financial advisor space, Nick Murray, where he was talking about this specifically, which is if you had 5%, but inflation was 3.5%, well, your net real return is 1.5%, which is no better. It's actually worse than what we had 5 years ago with 2% rates and 0% inflation. Like, you're actually worse off than you were 5 years ago, even though you're getting 5%.
Yeah, it's false. It's a false sense of
false security.
I'm making this money.
Correct.
You're not, because you're not really that much outpacing what the economy is doing.
Right.
And how it's affecting you day to day.
Right.
Interesting.
And then you stack
things I don't think about.
Yeah.
Because I'm not an advisor.
Right. Compliance. And if you stack on tax rates on top of that, right, we had a lot of clients that, had an additional $10,000, $15,000, $20,000 in interest alone based on how much their money had sitting on the sidelines in bank accounts.
Right.
Well, if you're at a 30% tax rate on top of that, plus inflation, you're really not making out better.
Interesting.
You should have just owned stocks and made 25% over the past year, right?
Well, now that we're kind of talking about cash, we have cash as a word on here, and I'm assuming you're going to I'm curious where you're going with that, because to me, that cold hard cash, greenbacks, that's what I think of.
Frozen money. You fold in money.
Yeah, you fold the money. You got it stowed away.
Yeah, right. So cash can mean a lot of things. It can mean that, right? Like you're folding money, your greenbacks, dollar bills, right, y'all? But it can also be just having your money in a bank, right? Like and that's what we call cash,
like a savings account.
Yeah, we call that cash or cash equivalents, right?
Checking.
Right. Yeah, checking, savings, CDs.
Because I hear the term, you have your money sitting in cash.
Yeah.
Does that mean it's in a liquid account where you can get your hands on it, as opposed to?
All that means is that it's not invested in something else.
It's not invested in a stock.
It's not in stocks. It's not in bonds. It's not in real estate. It's not in crypto. It's not in alternatives. It's not in commodities.
Down at the bank.
It's sitting at the bank in a digital format. Yeah,
correct.
That's what cash is.
Okay,
right.
Got it.
So, and that's an important thing. Like those three together: stocks, bonds, and cash, because that's the three main buckets of definition that you'll see on investment account statements. Like most 401ks or other retirement plans today, first page of the statement will show the investor, the plan participant, hey, here's your allocation of equities or stocks, fixed income, bonds, and cash or cash equivalents. Because those are the three primary categories we focus on. Like you own something, you loan your money, or you keep it safe and guaranteed, that kind of thing. But all that plays into another definition we don't have on the list that we should, which is asset allocation, right?
Okay.
So asset allocation is just the way that we spread our money out across different types of assets. So if we say that assets are stocks, bonds, cash, maybe that's real estate, maybe it is other types of things. Asset allocation is just how we diversify or spread our money across those different types of things to manage risk, manage return expectations, things like that.
So while you were talking about that, it kind of made me think of another thing. That's why I had to grab the pen just to make a note, is risk tolerance. I feel like we're talking about stocks, we're talking about bonds, we're talking about some risk already. Try to explain about how my risk tolerance and your risk tolerance are different, and how that kind of plays into what investments are chosen, and what does risk tolerance mean?
Yeah, so that's a really loaded like super loaded and like way overused and over abused term in my opinion. And I think that there's actually two components to that.
Okay.
There's risk tolerance and there's risk capacity. We've talked about this a little bit before too in the past. So risk tolerance, right, is kind of that more emotional feeling of like, how do I respond or feel or react when I see valuations fluctuate, right? It's like we know that investment accounts will go up and down based on the actual investments we own in them.
Okay.
And anytime you think about investing, you would go through like a risk assessment. That could be conversationally, that can be an actual form, things like that. But a lot of the questions to help identify risk tolerance is just trying to put people on a scale of how do we feel like emotionally, how do we feel about seeing values change, right? It's like 2022, we had a really bad bear market, meaning the market went down, right? Bear slashes down with its claws. It went down. People were scared. They felt uncomfortable because values declined inside their investment accounts. But if we had a high risk tolerance and we were invested in appropriate types of investments, we know that's the perfect time to put more money in, right? Because 2023, we had a great bull market. The bull's horns go up, right? That's a bull market. Everything came back up and far surpassed what it went down in 2022, right? Which recovered everything that was lost. So the reality is like risk tolerance is more of the emotional side of risk.
Okay.
I think it's actually less important than the other side, which is risk capacity, because that's where we think logically and objectively around, well, what are our actual financial priorities and what are our current resources and our plan to build more resources to be successful with our priorities and goals. So I always break that down two ways for people. If you're common thing I'll say to people is, if you are currently 22 years old and you have $100 million, great. Be as aggressive or as conservative as you want to be, because it really doesn't matter unless you're spending $10 million a month, right? Then we have a problem, but that's more of a bigger issue to deal with.
Okay.
But if you're 63 years old and you're just starting getting invested and you still have a little bit of consumer debt, you can't afford to be risky, you can't afford to be aggressive, and you can't afford to be conservative, because you have to make up so much time and so much margin that you're actually better off to be aggressive than just parking your money in something conservative. So that's where the capacity piece comes into play.
Okay.
Is you have to be thinking proactively around, will my current resources match or help me get to where I want to go based on what's available?
So what I'm hearing and what I think is an important takeaway, because we're getting like really lengthy in this definition.
Yeah, we need
right?
to shorten it up.
That's okay. That's why I'm here. Is that risk, be it tolerance or capacity, is defined on an individual level.
It is.
And it is up to your financial professional and you to work together as a team. And if you are also investing with a spouse, to find that medium and find that sweet spot for you guys, for you individually or for you as a couple.
Yeah. And the way to primarily like moderate how much risk is in your financial life is by adjusting what kind of assets you own, right? How much stocks versus bonds versus cash versus other types of assets out there.
Which then makes me want to know, do you want to jump and talk about what diversification is?
Yeah, let's talk about that.
Before we talk about the other two?
Yeah.
Okay, great.
So diversification, that's a word that gets thrown around a lot, right?
I'm diversified in my... See, I feel very fancy. I feel like I'm on a yacht with my tea in the morning. My pinky's out.
Yeah.
Are your stocks and bonds or your accounts diversified?
Well, to be honest, if you're on a yacht drinking tea like that, you've got a lot more than just stocks and bonds.
I
Let's say that, right?
But just because it just seemed very fitting. Oh, how's your diversification?
Yeah. So diversification is just how you spread things out across different types of assets.
Okay.
Right? It's instead of putting all my money in one individual stock or one individual bond or one individual CD, I am buying a lot of different things and getting the collective benefit of all those things together, right? So that's like if we were to buy mutual funds or exchange traded funds. That's a real easy way to diversify your assets, because we could buy one share of one of those types of funds and get ownership of hundreds of different stocks or hundreds of different bonds. Or if it's a money market fund, hundreds of different cash vehicles. Or maybe it's an asset allocation fund where it's like a target risk or target retirement date. That's where it's actually a mix of a bunch of different stocks and a bunch of different bonds and a bunch of different
What is an example
cash.
of a investing behavior that is not considered diversification?
Speculation.
Okay.
So that's what we call it, right? So if you're just putting everything on Tesla, for example.
Okay.
If you're just putting everything into Apple, or if you're just putting everything into, Amazon, or even if you're like, there's a lot of misnomers around the concept of dividend investing, which actually does not historically perform better than just diversifying across all different types of stocks.
Okay.
Things like that.
And I'm asking these questions at risk of coming across as really just remedial, not knowing these things.
That's great. I love it.
People talk about day trading.
Yes, that's speculation.
That's speculation, where you're playing one stock. Is that correct?
Well,
or
it could be.
You're probably looking, and obviously there's people who are very successful with that.
Very few people.
Right. But people do. I don't want to discredit the fact there are people who do have success with that.
I would love to discredit that,
okay,
actually,
well,
personally.
I don't, because I'm not an authority here.
Yeah, no. So, so realistically, like if you're doing any kind of speculation, and this is with stocks, whether you're day trading, like we are like constantly buying and selling, where you don't really care what you own. You're just looking at prices and movement of prices to try to build in margin as you buy and sell, which is technically the same thing.
It seems like a lot of work and a lot of time to be invested.
It is. And that's why most people are not successful at it.
Right.
Versus just buying funds and diversifying by buying one share of something.
Okay.
Yeah.
I feel like people talk about the stock and talk about the day trading because it sounds fun and it sounds exciting.
Oh, it sounds super sexy. It's high energy.
Exactly what
it's high octane kind of thing.
But then those are also the people that I'm thinking like, this is an ego play and you don't have any money.
Right. And I'll say that fully confidently.
Yeah, absolutely. And I'll say that too.
Send me your hate mail. I could care less. I will respond to your messages. The reality is the way to build wealth is patient capital and doing boring, proven things over and over and over again.
Well, isn't that how you build any kind of success?
It is, yeah. Whether it's
a
financial
behavior over time.
Yeah, financial, relational, health-wise, career-wise, education, like anything is like a slow, constant drip of doing good behaviors.
A good marriage is not the most amazing honeymoon and then a terrible life after.
Right.
That's not going to be fruitful.
Yeah. You're actually better off to have like no honeymoon and just go on weekly date nights where you talk about real things that matter.
Weekly date nights equal mutual funds and diversification.
More like dollar cost averaging.
Sure.
But
there's another term.
Yeah, we'll come back to that. But so like diversification is just spreading your money, like in financial terms, spreading my money across a bunch of different things so that as the rising tide of wealth and as the rising tide of the markets or whatever asset class I'm buying goes up, I get the benefit of that.
Okay.
Yeah. And a great example of that is if we look at 2023, it was a really stellar year for the stock market. In terms of like large companies. So everyone talks about the S&P 500, which is just a combination of the 500 largest companies in the U.S. stock market, right? But if you look at the actual numbers, let's say there's 500 companies represented.
Okay.
There's something called the Magnificent Seven, which is the 7 highest performing companies of the year for 2023. Well, out of all the 500 companies, those 7 companies out of 500, 7 of them carried like 99% of the return for the entire year. So diversification.
80-20 rule.
Right. So if you just went and picked like different stocks, right, then you had to be right on almost every pick. Or you're more likely to be wrong on every single pick you purchased and lose money for the year when you could have just bought something that had exposure to everything and gotten the benefit of that.
Because at least you would have had some of the 7 instead of potentially none of the 7.
Exactly.
Okay.
Yeah. That's why diversification is important.
493 chances to not be right.
Right. Yeah.
That's a lot of chances.
Right.
Statistically.
Yes. Yeah. So going from there, like another term that gets thrown around with investing is compounding.
Okay.
So what is compounding?
When things build on top of each other, and
Yeah.
things grow.
Right. Yeah. So compounding versus, so really when I think about this, it's in terms of like compound interest versus simple interest, which is a
Okay.
concept, if you took an algebra class in high school, you learned about, right? We all forgot about it
I don't know.
because that was one of those things where the teacher told you you'll never have a calculator in your pocket when you get older. Well, guess what?
We do.
I can
It's on
do
my
a lot of
phone.
calculations on my phone, right? But compounding is just the concept that like as we make money, our money then makes money for us. We're putting our army of dollars to use, and then as that creates more dollars, those dollars get added to the army. They create more use down the
Okay.
road, versus just having like simple growth or simple interest, which is we have a starting point, and that starting point is what keeps producing more and more return over time. But the return we actually make doesn't create more return for us.
Okay, so can you give an example of simple interest in at work in people's lives?
Yeah, so simple interest is the way most fixed debt operates,
Like your mortgage?
like a mortgage,
Yeah.
a car loan,
It's
student
amortized. You
loans.
see everything.
Yeah,
There is no
there's a specific schedule of
compounding
how
of the
that
interest that you owe back
exactly.
to your mortgage lender or
But
mortgage servicer at that point.
But on the flip side, compounding is the way credit cards work.
Right.
Right. So if you don't pay off your balance and you generate interest for your statement period, and then you don't pay off that interest, well, that interest
It's
and
now
the
your new
accrued balance
balance.
now has more interest grow on top of it.
Right.
Which is part of the reason why we're not a huge fan, for the most part, around like debt consolidation or refinancing debt that already has a lot of accrued interest into new debt, because then you're compounding that debt even more into new interest that's going to keep growing and building instead of being able to make faster progress paying stuff off.
Okay.
Yeah. Good question. Where do you want to go from here?
Well, I don't want to throw you off. Are you wanting to go into depreciation, or you want to go back up to the qualified and non-qualified?
Yeah, let's go to qualified and non-qualified.
Okay.
So, go ahead.
Before we just say the definitions of those, just to preface this, there are types of investment accounts that are classified as qualified, and there's some that are classified as non-qualified accounts. So that's why this is how this term is even used in this industry, just to kind of give you some background in case you've never even heard a financial professional or anyone refer to anything as qualified or non-qualified.
Mm-hmm.
So tell me the differences here and make it easy to understand.
Yeah. No, you're good. So the difference between qualified and non-qualified is anything labeled as qualified has special qualifications for how the money gets treated. That's all it is. And it all relates back to our tax code in the U.S.
Okay.
So there's really 3 different buckets of qualified accounts. Everything else is non-qualified.
Okay.
So qualified categories are typically going to be retirement assets, it's going to be healthcare assets, and it's going to be education assets. And all this relates to how your money is taxed as you put it in and how your money is taxed as it comes out.
Okay, so your 401k,
Yep.
your Roth IRAs,
Yep.
which are very common, accounts to have
Yep.
qualified.
Correct.
Your children's 529,
Yep.
qualified.
Yep.
Okay. HSA.
HSAs, FSAs,
All
MSAs.
that. Okay.
Yeah.
So then non-qualified is a brokerage account?
Regular old plain Jane investment account.
Okay,
Yeah.
just outside of retirement dollars, outside of healthcare, and outside of education.
Exactly.
Okay.
Yeah. So like the qualified side, a common example of that is on the retirement side. If you have a traditional or what we call pre-tax account, you put money in today and you can qualify for a tax deduction for how much money put in there, how much money you put into that account. So what that means is like you're technically not getting taxed on that money that went in today. And when you pull it out down the road in retirement, you're going to have to pay taxes on whatever originally went in and the growth on those funds because you got the deduction early. It's kind of like I can bank my tax savings today or I can choose to have my tax savings in the future.
Okay.
That's the pre-tax or traditional side. The opposite is Roth. And by the way, Roth is just the last name of the senator that sponsored the legislation
However
to
many years ago.
establish what Roths were in the 90s. So the Roth type account is I put money in today and I don't get a tax deduction for doing so. But because I put it in the right way and I take it out the right way in the future, all the growth and that original investment that I've already paid taxes on is tax-free when I pull it out. The non-qualified type of stuff, that's a regular brokerage account. Some people call it a bridge account or a mutual fund account or a taxable account, things like that. Those accounts, you don't get any kind of deferral or special tax treatment of the growth inside your account each year as you have money growing inside there. So you put money in today that you don't get any kind of tax deduction.
Okay.
And then whatever real earnings you have, like interest, capital gains, dividends, things like that, each year as those are earned, you have to pay taxes on that based on your tax rate and tax stipulations. So you don't get any kind of like special tax treatment. That's really the key difference between qualified and non-qualified funds.
Yeah. And I'd also say, like, if you're listening to this and you're like, oh, I'm still a little unclear about it, absolutely reach out. Reach out to us. Let us know. And Patrick, is more than happy to help kind of clarify some things too as well.
Oh, yeah.
Or
for sure.
that also shows, hey, we need to do another episode
Yeah.
on this
Oh, for
specific
sure.
topic. Because if one person's thinking it, there's got to be somebody else for sure thinking it too.
Yeah, exactly.
Okay, well then let's go to depreciation.
Depreciation. So this is more of a more complex topic or
right,
complex
and we talked about
thing.
it a little bit when we were talking about the assets.
We did, yeah. And what I referenced there is like you can have appreciating assets or depreciating assets. And depreciating assets is just where the useful value of something declines over time.
Like a car.
It wears and tears over time.
Right.
Or if you have equipment for your business, like that's going to wear down in useful life over time. Clothes are depreciable because they disintegrate over time.
But sometimes these things can be positive when it comes to tax time.
When it comes to tax time, yeah. And that's specifically thinking about for like business owners and real estate investors, things like that, right? So depreciation is just a concept where you can actually, against your taxable income, take what we call like phantom losses or paper losses against the actual value of your earnings to help reduce your tax bill. So a common thing is, if you buy a vehicle for a business, you can depreciate the useful value of that vehicle against your earnings or your positive income year by year until that's fully run out. If you think about real estate for residential properties, I believe it's 27 and a half years. You can depreciate the value of that property over that time frame. Commercial properties, 39 years, where basically you're just taking whatever your purchase price is, plus any kind of improvements you've done sometimes, and you divide that up over that number of years, and that's how much paper loss you get to write off against any kind of income generated from that. You're looking at me with a cold stone face right there. So that is a more complex thing, but it relates to taxes and it relates to business owners.
Teachers in school as well. I'm sorry.
Yeah.
Come again.
Yeah. But no, it's a term that talks about like how the value or the useful value of your assets declines over time.
I would say if you're somebody who is a business owner or it owns real estate, right?
Yep.
And you are talking about depreciation, most likely you have some financial professionals and tax professionals in your corner who are working to figure all this 27 years stuff out with you.
Yeah. Right. And that's just one example.
I know.
But definitely if you are a business owner, and when I say business owner, that would also include a sole proprietor. So
like
if you're
a 1099?
1099 employee, if you have an LLC, but you're the only person and you have maybe some employees or no employees, like you would be able to take advantage of this kind of stuff to actually help on taxes. Yeah.
Okay. Don't ask me to explain this one back.
You're fine.
You're so funny.
No worries. We'll have it recorded so you can go back and listen to it.
Well,
that's the key
I
thing.
don't know if hearing it the same way over and over will make it better.
Yeah, you're okay. A whiteboard does a lot better with that. So, so the next two are really important for everyone. Like literally, if you file taxes, which you should, it is illegal to not file your taxes. It's not illegal to not pay your tax bills, by the way, which is interesting. You have to file. And you can go to jail for not filing. That's how they got Al Capone, by the way, tax evasion. Okay. But it's not, if you don't pay your tax bill, there's less penalties. Yeah. It's weird the way it works. But anyway, so tax deductions and tax credits. So when you think about these two terms.
I'm going to ask probably a lot of questions on this.
That's okay. That's good. So think about these two terms, tax deduction and tax credit. A tax deduction is something that reduces how much money you're taxed on.
Right, meaning it reduces what the government sees as your income for
Correct.
the year.
Correct.
Okay.
Which ultimately can reduce your tax rate and reduce how much taxes you owe because you've reduced your taxable income.
That's wonderful. How or what is an example of a tax deduction, Mr. Rogers?
Tax deduction could be those pre-tax retirement contributions.
Okay.
It could be contributions to healthcare savings accounts. It could be, depending on your state, contributions to a 529 college savings plan. It could be just the standard deduction that everybody has the opportunity to claim on their taxes. It could be charitable contributions if you itemize, mortgage interest, things like that.
Okay.
For business owners, there's a whole different slew of tax deductions, and that's actually what we're going to record next, is talking about our favorite tax deductions for folks.
Just write it off.
Just write it off. But
it's like invisible money.
Yeah.
No, it's not.
So once you've satisfied all your tax deduction opportunities, though, that's where tax credits come into play. And a tax credit is once we know what our actual bill is for how much taxes we owe, like our total bill, not accounting for how much we've already withheld throughout the year through paychecks and things like that.
Okay.
But let's say your tax bill is $10,000.
Okay.
Right? And you have tax credits that equal $5,000. That is a dollar for dollar reduction on how much you actually owe.
So then you only own
So you only owe $5.
Okay,
right.
So a tax credit.
Yeah.
I don't know.
So there's a lot of them.
Is there something about having a child?
Yeah. So there's child tax credits.
We got that.
There's earned income tax credits. There are savers credits. There are charitable contribution credits.
There's charitable contribution credits and deductions?
In some ways.
Okay.
Yeah. That's a more complex topic.
Okay. Got it. Sorry.
Yeah. I shouldn't have said that. Anyway. We don't want to go too deep on that stuff right now. But the long and short is there's different kinds of credits you can get that help reduce your actual tax bill of what is owed. There's two different kinds of credits within that realm, though. You have what's called refundable and non-refundable. So refundable credits is, let's say my tax bill is actually $1,000 and I have a $2,500 credit that is refundable. Technically, if I owe $1,000 and I can take away $2,500, I go down to zero and I don't owe anything anymore.
Oh, okay.
But the refundable credit, there's technically a negative $1,500 because I had $1,000 minus $2,500. Right. I actually get that $1,500 deficit back as a refund. A non-refundable credit is if I owed $1,000 and I had a $2,500 non-refundable credit, I just go to zero and I don't get any kickback based on that.
Okay.
So we like refundable ones because if you do go to zero on your tax bill, you can actually end up getting more money back from the government. Okay. Versus the non-refundable, you don't get that benefit. It's a lot.
I'm not in taxes for a reason.
Yeah, right.
One of my friends that are.
Yeah. So let's take that and let's skip over to a few estate planning terms because I think estate planning is one of those things that a lot of people know is important, but it's usually an afterthought and doesn't really get addressed appropriately when it should. So the three main things we talk about with people for estate planning is we have a will, a power of attorney, and a trust. So a will is just your personal document that specifies how your assets get transferred when you pass away. Assuming you don't have other things set up like beneficiary arrangements or other legal arrangements to have your assets get divided up when you pass away. But that's kind of like your final instruction manual of, hey, I died. Here's how I want my stuff distributed. That's what it is. It also has different clauses in there to determine how your kids could be taken care of if you have minor children. It tells how the administrator of your estate would have to pay off debts or satisfy other liens and loans and things like that against your estate. You can have a lot of things there like professions of faith. Really, it's a very open-ended document that you can build out a lot of different ways. Okay. Every state has its own estate laws, though. So if you move from state to state, it's good to have that updated to make sure it matches your current estate provisions or your current state's laws.
Okay, good to know.
But overall, it's kind of like that final instruction manual of how your residual assets get distributed after you pass.
Okay.
A power of attorney is a document that basically there's a triggering event or set of triggering rules that allows someone else who is your named attorney in fact, is what it's called, to actually act on your behalf in certain situations. Yeah. So you have like medical powers of attorney, which is someone who can make important medical decisions based off of your incapacity.
Right.
You have financial powers of attorney. There's durable or like general powers of attorney. There's different kinds, but essentially it's just a document that grants someone the authority and the opportunity to make decisions for you based on certain triggering events.
Okay.
And the last one is a trust. And I think this is one that, is also kind of the, I have a trust.
Yes,
like that
very
kind of
fancy.
thing, right?
There's different types of trusts.
Lots of different types of trusts.
I don't know all of them, but the ones I do know, there's irrevocable trusts.
Yep. There's irrevocable. There's revocable. There's,
and that's all Haley knows.
Yeah. There's living trusts. There's charitable trusts. There's a lot of different kinds, and a lot of that changes over time as different estate laws and tax laws change.
Okay.
The long and short of it, though, is a trust is a separate legal entity from yourself. It's a non-natural person, meaning it's created as a separate legal person in the eyes of the law, where it has its own like tax ID number and things like that. And you can own it. Like we could have our own trust that we set up today and we fund it, and like that is something we own, and that trust can own different assets we assign to it.
Okay.
And it's just a good way to protect your assets and have another person that just can't like pass away because it's not a natural person. It's just a legal entity set up under the laws. They can own assets and distribute and manage assets after you pass away or for your benefit, for someone else's benefit, things like that. So it's kind of a way that setting up a trust is a way that you can put specific parameters on how your money is used once you pass away or if you become incapacitated. There's a lot of parameters around that.
Yeah.
But the long and short of it is it's kind of like it's just giving an instruction manual of how your money gets used.
My only other question is, there's wills which say how the money's used. So what is the point of having a trust, or what sets someone apart that you might be a candidate for a trust versus you might not be, or whatever?
Yeah. So the primary purpose of a trust is to remove assets, and from my perspective, and the ways that we typically see used.
From a personal human being?
Yeah. Is to
protect it.
To remove those assets from liability, meaning like if you have assets that you move into an irrevocable trust and you get sued, those assets are not subject to that.
Because they're not yours.
Because they're not yours anymore. Exactly.
And
that becomes...
Can you be named as like the managing trust person?
Yes. So you can be the person that is the one that granted the assets, but also the person who receives benefit from it, the person who manages it as a trustee.
Because it's not technically yours, it's the trust's. It can't be touched.
Correct, assuming if things are set up correctly. And that gets into a lot of complexities around like how...
This is one of those things I like to pull the thread and talk to you about.
The legal liability piece, that's not the main focus that I would think about.
Yeah.
I would think more so around how do I have assets transfer when I die outside of probate? Because we don't want assets to get tied up into the probate process where, your family that might need access to those assets, have to wait 9 to 12 months to actually get access to it.
Okay.
Instead, we can have money put into the care of a trust, and the trustee can distribute those assets accordingly based on the requirements that are set up for it.
Okay.
And that's always working with a licensed and licensed attorney to set those up.
Right.
Yeah.
Yeah, I was going to mention something like that.
Yeah. So that's a lot of definitions. We've covered a tremendous amount of stuff. We've definitely added a lot of color to that over this period of time. Any final thoughts or questions, things you want to go through right now?
No, I don't think so.
Okay. All right. Well, perfect. Well, like you said before, there's a ton that we can keep going through. We will save everybody the opportunity for that in the future.
Right.
But as a reminder, as we close out, please like, share, review the content we're recording because we enjoy doing this. It's kind of a fun way to just, banter and collaborate and share ideas and things. Maybe give us a little bit of an ego play. I don't know, but we love your feedback, love your content. Tell us more things you want to hear about. Give us ideas of things that are relevant for you that'll be helpful, and we will dive in. And with that, we'll see you next time.
Great. Thanks so much, guys.
Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.